Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Hello, everyone, and welcome to another episode of the Australian Investors Podcast. I'm excited to have one of the co-founders of a fund called Hayborough Investment Partners, Ben Rundle, to talk about his journey, investing philosophy, management and culture, and also valuation. Welcome, Ben. How are you?
Good. Thanks, Raymond. Thanks for having me on the show.
I understand you're usually based in Sydney, but Adelaide boy at heart. So
that's right. Yeah, born and bred in Adelaide. So I'm here at the moment for Christmas.
Great. And also, I guess that's the name of a suburb close to your heart in Adelaide as well, Hayborough.
That's right, and that's where the name for our fund came from.
Awesome.
But yeah, normally based in Sydney.
Awesome. So I'd like to dive into your personal background. How did you get started investing, and how did you get so passionate about it?
Yeah, I mean, I think like anything, I initially got into investing just through a fascination with how the stock market worked. I had a mentor, a guy by the name of Jeff Day, who ran a stockbroking business in Adelaide, who eventually sold it to Macquarie Bank. And he would often talk to me about investing in companies and how the market worked. And it just really fascinated me. And I think that, you know, if you sort of I've sort of found if you let your path be dictated by what you're interested in and what you're fascinated about, you'll tend to do better than the alternative. My father had a successful career in property, and I always had a view that I didn't want to go into property because I sort of wanted to create my own path and not be in his shadow. So that wasn't really an option, but the stock market was something that fascinated me and ended up pursuing that career, which has been fantastic.
It's interesting you say that, because I think Aussies have a fascination with the property market. There are similar traits, but were there any key differences between property and the share market that really attracted you to the latter?
I think it was initially born out of the fact that I didn't really understand the stock market as well. And property, you know, it's pretty easy for anyone to understand. But at the time I was young and I'd hear about these people that made money in the stock market, and some would make money by investing in mining companies, and some would make money by short-term trading, and others would make money by buying assets at 50 cents on the dollar. And it fascinated me that there were so many different ways to make money in the market, and that's something that has really, I mean, it's stuck with me today. I meet people from all parts of the market who make money in various ways and have been successful in doing so. But I think that's kind of what initially attracted me to it. What I sort of found was that over the course of my career, you end up coming up with your own ways and own ideas of how you think money should be made. I'm very fond of a saying that you can borrow someone else's idea, but you can't borrow their conviction. And what that means is essentially, you can take a stock tip from someone else, but that stock does well or it does poorly. How will you know when to sell it? I think to make money in the market, certainly the way that I have been able to do it is by holding on to companies for a period of time where not everything is going fantastically well all the time. Sometimes the business is going well and the share price is not. It's obviously a very volatile or can be a very volatile way to make money. But I think over the course of the long term, if you own good businesses, the share price will eventually follow the performance of the business. And if you're owning the shares for the long term, if you're right on the underlying business, then it's been my experience that you'll make money doing that.
Yeah, I think borrowing conviction has been an important lesson for me, because you always see these really reputable fund managers like yourself commenting on businesses and stocks. Sometimes you can get led to a certain position on a certain stock, So yeah, it's a really good point.
Yeah, I think there's nothing better for someone in the stock market than to do their own work and really come up with their own ideas and their own convictions. And, that might differ from what other people are telling you, but sometimes, you can make that, sometimes that's where the best money is made, where you own a company where, not a lot of people like it or not a lot of people want to own it, but it does well. And, probably a recent example of that is Afterpay. I mean, there were so many bears on that business, from $2 up to well over $100. There was plenty of people who said it was too expensive. The model doesn't work. It needs to be subject to credit rules. Yeah, maybe all of those things had some portion of truth to them, but it didn't stop the fact that the share price did incredibly well. And those people who had their own conviction and held on to the company that whole time have made an extraordinary amount of money.
And on the topic of businesses, I understand that you found a media business called Quick Charge. Is that right?
Yes. Yeah. Yes, I did. Yeah. So actually, maybe if we go back a step from that. So if you look at my career to date and how I got to where I am now, the traditional model of going into funds management at the moment seems to be that uni graduates want to go straight into it. And while that can be a fantastic path, the path that I went down was actually via the stockbroking route. And why that I think that worked for me was the fact that if you go to a funds management business, there's very low turnover in funds management amongst staff. So you go to a funds management business, you work there for, maybe 5 to 10 years, and maybe you stay there, maybe you move on, but you're learning one style of investing, being the way that fund invests money on behalf of their clients. On the stockbroking side, you get to see hundreds of different fund managers and their different styles of investing, what they do when the market sells off, aggressively or goes through a significant downturn. Understand how they behave, what sort of stocks they buy, and you'll sort of naturally gravitate towards those fund managers who their investment style resonates with you. But the point of it is that you just get such a broad array of how the market works. I mean, how the sell side works too is a great thing to learn, because I see fund managers who might be able to value a company, but they don't really understand the nuances of dealing with the sell side and what works and what doesn't in terms of those relationships. And that for me gave me a great foundation to forge my own path on how I thought about investing. How the media business came about. So in 2007, 2008, I was working at Macquarie Bank, and I was in the structured products division, which created all of these derivative type products, which were then sold to investors that had various forms of leverage, perceived protection, and during the GFC, a lot of those products unwound significantly and lost people a huge amount of money. And that was a good lesson for me insofar as that you want to stay away, or personally for me, I want to stay away from derivative products whereby I don't really understand what the underlying risk involves. And I think a lot of people that own those products don't understand the risks involved, and they might work well in one market environment, but they can very quickly unravel when you hit a period of, at the time where the credit markets essentially froze. So our division at Macquarie went from making the most amount of money in the whole bank to making the biggest loss in the whole bank in the space of 12 months. And at that point, it dawned on me that, I hadn't really had any experience running a business, and it was something that I wanted to gain insight into. So myself and a good friend of mine started a business called Quick Charge Media, whereby we had essentially these kiosks which charge up your mobile phone battery. And they've got a TV on them as well, which we were hoping to sell the media on. And we had them throughout most of the major airports in Australia. We had them through universities, and we had them through some convenience stores and that sort of thing. And it was great insight from 2 points of view. Firstly, the fact that entrepreneurship, not everything goes well. There's a lot of people I speak to who want to start their own funds. It's certainly not for everyone. There are times, I had a conversation not that long ago with Michael Heiner from NetWealth, which has been an absolutely fantastic success story. if you speak to Michael about the early days, there are plenty of times where they thought it wasn't going to work. There's a lot of dark days running your own business, and that was something that we became acutely aware of pretty quickly. And the other lesson I learned out of it was that, and this is something that stayed with me today in terms of my investment style, is that return on capital is one of the most important things that you can look at in terms of financials for business success. So when we had these kiosks, I think from memory, they might have cost something like $3,000 US each. So if we wanted to roll them out through Australia, which we certainly did for a while, there's a significant capital cost that comes with that. And the return on capital of the machines wasn't fantastic. And we quickly found that out, that while the returns were okay, it was going to require a significant amount of money to scale the business around Australia and then potentially go offshore. So we eventually sold that. That was, as I said, a fantastic experience in terms of running a business. But the whole time while doing that, I sort of had one eye on the stock market and one eye on the companies that I owned. And that I guess reinforced my view that what I want to do in the long term is stay in the stock market and invest on behalf of clients.
Were there any employees as part of the business? Did you have to manage that side of things as well?
No, there was just two of us, which made the workload pretty hectic.
Right. Okay.
I can imagine if we had employees, that would have only increased the complexity of it all. And I admire people that run very large teams, because I can't imagine it's easy to do.
Yes, I think, it's incredibly hard to manage a big workforce. So you often appreciate that the absolute big companies in the world, like Amazon, that just have like so many employees, right?
Absolutely. I mean, it's a very difficult people. And if we look towards my investing philosophy, I'm a big believer in the fact that people run companies, not spreadsheets. So you need to nurture those people and look after them, and that's not easy to do when you've got a staff that can number into the hundreds or thousands.
On staff, do you handle the recruitment side of your own fund? Do you pick and choose?
At the moment, it's just George and myself,
Okay,
which makes life easy. The approach that I think we will take towards hiring other people is that we will hire very slowly. So we'll spend a fair bit of time, in fact, probably a lot of time looking at the right candidate, making sure that they fit in with the business and our philosophy. And really that person, what we're looking for is a high level of integrity. I think you can train someone to look at companies in the same way that we do, or even bring their own insights. But if we have someone that has high level of integrity and fantastic character, I think that's a great start.
Ben, I want to peel back earlier in your role as a portfolio manager at NAOS Asset Management. I believe you spent 6 years there.
I did, yes. So NAOS were a client of mine when I was on the stockbroking side, and I got along well with Sebastian Evans, who's the managing director there, and eventually moved across to help them run a portfolio. And NAOS has a very high conviction approach to investing, which involves portfolios that have around 10 to 12 positions in them. And if you're going to have 10 to 12 positions in your portfolio, you need to know those companies better than a lot of other people do. And you also need to own them for the long term as well. So that deep research approach was a fantastic way to understand a lot of these companies, how they work, what makes companies grow and prosper and do better than the competition over time. If you're running a portfolio like that, you're gonna have various levels of success. And when things go poorly, they tend to go quite poorly for a while and stay that way. But it is a very great lesson in terms of doing enough work on a company to understand it and really know what the drivers of the earnings are going to be.
Now, I understand your current fund holds around 20 to 40 positions.
That's right. So we're less concentrated than what we were at NAOS, that's for sure. So I think we've got almost 40 companies in the portfolio at the moment.
Is that due to your personal preference in the way you and George like to invest?
Yeah, you're spot on. That's a personal preference in terms of the companies that we're looking at. What it does do is it gives you the flexibility to own a business whereby you're probably still understanding a lot of things about that business. If you look across our portfolio, most of the companies we own, George and I have known for 5 to 10 years. But there's a few sort of smaller positions which maybe they've recently listed or we've only just recently come across them, whereby we own shares in the company, but it's only a small portion. And I'm a big believer in the fact that you don't really know a company until you own it. Once you own it, you start to obviously do a lot more work on it. You take a lot more interest in it. You speak to a lot more people about it, and you really start to understand the company a lot better. So we've given ourselves a bit of flexibility to employ that approach within our portfolio.
Just to switch gears a little bit, I think it would be great to get the personal side of you. Do you do anything outside of work that keeps your mind off investing or helps you rejuvenate?
Well, we've only when you're running your own company, it's there's not a huge amount of time outside of work for anything else. I do like to exercise each morning. I think that has been a fantastic way for me to start the day and re-energize myself and really hit the ground running. When the business day starts, outside of that, I try to play tennis once a week, and I've got a young family as well who keep me busy too.
Okay, awesome. It'd be pretty hot to play tennis, so it must be tough at this time of the year.
yeah, it does get pretty warm.
Yeah. So in terms of your overall investing philosophy, I guess it was strongly shaped by NAOS Asset Management, given you spent a lot of time there, so it's very high conviction. In terms of trying to find investment ideas, is it turning over the rocks and trying to find the highest quality businesses and monitoring them over time? And is that how you go about finding ideas? Or
yeah, so I would say to start with, my investing philosophy has taken various points from my time at NAOS, my time on the stockbroking on the sell side, and brought that all together into one philosophy that I think that resonates with me. And the reason that George and I went into business together is because it seems to resonate the same way with both of us. And a lot of that is the fact that, as I said before, people run companies, not spreadsheets, and we really want to invest in the people behind these businesses. In terms of ideas and the way we come up with those, I mean, they can come from all various forms. We've built networks up over many years of investing. I've been in the markets now for 15 years, George for 20. So over time, you build up, these investing networks, which I've sort of found have been the most fruitful in terms of ideas. We're speaking to other people that share a similar philosophy to what we do. Small investing groups that often get together and talk about stocks, speaking to people in the market, many company meetings, reading annual reports, watching the buying and selling of directors. I mean, they can come from various forms. It seems to be more of a serendipitous outcome, if you like. So there's a lot of hard work and running around and speaking to as many people as possible for very few ideas that come out of it. But when they do, they're often worth following up on. And you'll hear great investors say, if you come up with a handful of ideas per year, even 1 to 2, in terms of new ideas, you're probably doing well. And I mentioned before, our portfolio is constructed of companies we've been looking at for sometimes over 10 years. We know the businesses, we understand the companies, and it's often said that the best ideas are already in your portfolio. So our job is really to understand what we own and make sure we're still owning it for the right reasons.
So once you've found those high quality investment ideas that could potentially make into the portfolio, what's the screening process like? What do you focus most at the start?
Yeah, so if we're looking at, so there's two sides to how we look at a company, and most of the work we do is on the qualitative side. So understanding how the company operates within its industry, how they treat their staff, what their track record looks like, what their approach to capital allocation is, and that sort of thing. And why, really trying to understand the recipe for why they're going to do better than the competition. And then if we look on the quantitative side of things, if I'm coming across a business for the first time that I don't know, the first thing that I'll do is go back and look at the last 5 years and look at what the return on the incremental invested capital is. So simply comparing the current capital base to what it was 5 years ago and how that's changed, and how the earnings of the business that have changed over that time as well. And if that is at a higher rate, say above 20-25%, then it's certainly a business that starts to look pretty attractive. And then we'll look at the free cash flow of the business, the balance sheet, preferring to probably use the cash flow statement as a proxy for valuation rather than the profit and loss statement. And then once we've come across the company, we will speak to as many people as we can in and around that company. So we'll try to speak to former employees, we'll try to speak to current employees, obviously the management team, suppliers, customers, trial the product ourselves, and really try to understand the secret sauce behind the business.
So, yeah, I know from reviewing your investment process and your philosophy, it seems like there's a strong focus on management teams. I think you have a line there. You want management teams that think and act like true owners of the business. Could you expand on that?
Yeah, so it's been our experience that founders of companies who own a significant stake in their business will make decisions in a different way from a management team who don't have any stake in the business, have come from elsewhere, are getting paid a lot of money and maybe getting incentivized the wrong way to grow the business. Whereas if you have someone who owns the company and has skin in the game, they often, as I said, make decisions on behalf of the shareholders. Not always. Sometimes you do come across founders who don't necessarily do the right thing and they're very self-serving. But if people have a large amount of their own portion or net wealth invested in the business, then sometimes self-serving can benefit all of the shareholders.
In your most recent update for November, you mentioned a company called Beacon Lighting. I think a retail shop that a lot of Australians have come across. And it seems like, based on my initial review, they do have a high quality management team, and it's family run.
Yeah, that's right. So I initially came across Beacon Lighting when they IPO'd. I think it was in 2014. And I looked at it thinking, okay, this is a business which sells lighting products. Yes, it's family led, but is there really anything inside the business that can get me excited as to why they can win in their market? And it took numerous years of following that business to build up that conviction. But I mean, it's been a fantastic success story. So Ian Robinson bought the first store, and I think it was about 1975. And the family still own 55%. They haven't sold a share. And if you go back to their IPO in 2014, they've tripled the size of the business, and they've required no extra capital to do that. And that's something that I think is lost on investors in the market fairly regularly, is just that the extra capital required. I mean, anyone can go out and grow a business by spending a huge amount of money, going and acquiring other things, or reinvesting significantly in their business. And it's those businesses that don't require huge amounts of capital to grow that really, I think, will end up doing well over the course of time. They went through a pretty difficult period in, I think it was 2018, 2019, where economic conditions were okay without being great, but there was, you might remember when Masters closed down their business, they had a lighting segment which they essentially dumped all of that product onto the market. So it ended up being a very difficult period for Beacon. But sometimes when you see these companies and how they operate through difficult periods, it can really give you great insight as to how they handle it and how the business recovers from that. If we look at Beacon today, they control, I think, around about 20% of the retail lighting market in Australia, which is about a $1 billion industry. The trade market for lighting in Australia is about 2 to 2.5 times the size of that. And that's an area of the market that they don't have much market share in at the moment. I think they might have 2-3%. And they're starting to push into that side of the business. And they're using, there's another successful company who have done this in the past, the plumbing business called Reese, And they're trying to really copy the Reece playbook into having success with doing that. And it's my view that the management team, given their track record in running this business and their position in the market, will have success in doing so. On top of that, they've also got an offshore business which has really been bubbling away in the background for quite a number of years now, but they are starting to show some success from that. And the benefit of that business too is that a lot of it's done online. So using e-commerce channels, which can significantly improve the gross margin and improve the returns of the overall business if they have success doing that. They've also got a property trust asset business where they are essentially owning the land that a lot of their stores sit on, which I think, if we look out a few years' time, that'll end up being a really big business. So I look at Beacon today and think, well, this business can be, in 5 years' time, it can be twice the size of what it is at the moment. On my estimates, you're currently paying about a 5.5% to 6% free cash flow yield for the company, even after the recent rally it's had. And that, to me, I think seems to be a fairly reasonable investment to make, particularly given the background of the family and how successful they have been in growing this business. I think they'll continue to do that, and the business will be significantly larger in 5 years' time.
Yeah, I think another qualitative aspect I found really interesting from reviewing the past few years in terms of this management strategy, it seems like they're purchasing a lot of the franchise stores. I think they started off with a lot of franchise stores and now they're taking control of it and really trying to.
Yeah, so I mean, the argument of franchise and company owned is, it works differently for different businesses. I mean, Domino's has been a fantastic success story, which has worked well with the franchise model of doing business. And someone like Beacon, who owns the stores, has done well with that model. I don't think there's necessarily a better way to do it, but it might depend on different industries or different management styles. But both two examples there of great success stories that have done it differently. And I guess that's that's also the case in the stock market. You can have two people that invest completely different ways, who make money but have no relationship in terms of the ways that they invest.
So just reflecting on your earlier comments about monitoring the business over a long period of time, and since it IPO'd in 2014, it seems like management have taken a really long-term approach in how they deploy capital. I mean, they've tried to wait for the opportune times.
Yeah, that's very much a founder-led approach that we've found too, is that they'll make decisions 4 or 5 years out or even further than that, whereas someone else might be incentivized to grow the business over the next 1 to 2 years, and they'll make decisions on a short-term basis, and it's often the case that just doesn't work. And so, I think if you look at the great businesses that have been built over time, are exactly the same thing. I think Jeff Bezos says the decisions you made 5 years ago will shape how today pans out. I think that's very true for a lot of businesses that are listed.
So we've talked about a high quality management team at Beacon Lighting, but have you come across any management teams that you initially thought were high quality, but then it turned out to be the complete opposite, or maybe did not meet your high expectations?
There's been a few times where, so we don't, if looking at a current portfolio, a lot of the companies in there are founder led, but there are a few that aren't. And there's cases where a business might not be founder led, but the people running the business certainly behave as if they are founders and treat the shareholders accordingly. One example recently where that didn't play out quite as expected was with Bapcor. So Daryl Bolomy didn't start that business, but he was handpicked to run it. And in our time in dealing with Daryl, and again, I think they listed somewhere in 2014, he has been an exceptional manager of that business, and he's treated the shareholders very well in terms of capital allocation. He's basically portrayed all of the traits that you would see in a founder. Recently, only a few weeks ago, it was announced to market that he's suddenly leaving. Now that looks to be as a result of a board dispute, but the fact that Daryl doesn't own 20 or 30% of the business means he's not in a position to turn around to the board and say, well, I own this business. This is how it's going to be done. And I mean, there's a lot of water to go under the bridge there, but it's a case of the board versus Daryl, and the fact that he's not a founder means that he's out, and in my view, the company's lost a fantastic operator, and we'll wait and see how that goes for the company. But the share price has reacted in a way that would suggest that the market probably would prefer to have Daryl back in the seat.
When you say that some companies that aren't founder-led and management teams that might behave like founders, do you monitor certain personality traits or characteristics of the person and the decisions over time? Is that how you try and glean that?
One of the key ways to understand that is, well, firstly, there's the cultural side of things. How do they treat their staff? How do they treat their customers and all that sort of thing? But one of the ways that we like to assess the management team is how they allocate capital. And it amazes me how many companies that we find who have not really given much thought to capital allocation. If you look at any business, there's essentially three ways they can allocate capital, right? They can reinvest in their business, they can pay a dividend, or they can go out and acquire something. There are plenty of companies in Australia who pay a dividend. We spoke to a company recently and we asked them, they had very good returns on capital. They said, why are you paying a dividend? Why don't you reinvest in the business at those high rates of return? And their answer was that, well, we've always done it that way. And that to me just said that, well, they clearly haven't thought about how they allocate capital as part of, on behalf of shareholders. And it's often the case that management teams may not have been taught that. They may have risen through the ranks of the company and really had no experience with capital allocation. But it's our view that correctly allocating the capital can significantly drive shareholder returns over the long term. And if it's done incorrectly, you can find a business which might have looked okay from the outside. Management might have told you all the right things, but the business ends up dwindling and not performing as expected on behalf of shareholders.
I think monitoring capital allocation decisions is very important, and it's something that can be done, remotely through monitoring the financial statements and whatnot. But in terms of the behavioural side of things, have you found it more challenging to interact with management teams and trying to gauge or extract information or insights?
Yeah, look, I think we're quite fortunate in Australia where most of the listed management teams will conduct presentations fairly regularly, and they're fairly accessible to fund managers to have a chat about the business. And the more that you meet with a company, and the more that you talk to management and talk to people around the business, the more you're going to understand it naturally. So we try to do that as much as possible. If there's a company that we're following quite closely over the reporting season period, we might attend 4 of their presentations just to glean extra insights into the business. And obviously it takes us longer to do that and we cover less ground, but hopefully we understand those businesses better than what a lot of other people would.
So you touched on culture, which I think is a very important factor in assessing a business. And it's another qualitative thing that you can't really quantify. So I think it would be great to go into a deep dive into the ingredients of what makes great culture. I think in your October update, you mentioned PWR Holdings, where you actually visited the premises and you had that one line that was said by Keys about inventory. You rather look at it rather than look for it.
Yep, that's right. Look, it's our view that the cultural side of things in a business is very much overlooked by the investing community. If you look back to, and the way this sort of came about was through years of studying really, really successful businesses, and most of the time they have been offshore. So, if you look at Home Depot, for example, in the US, two guys started that business in 1978, in a very, very competitive industry against absolute behemoths. How did they win? Like, how did they end up becoming the winners of the business? And it's our view that really, and there's a fantastic book called Built from Scratch, which talks about the founders, Bernie Marcus and Arthur Blank. And it's really, if you ask them what the key ingredient to them winning, it was the culture inside of business. And I think that comes from the top. And there's a famous story about Home Depot, and that there was a customer that came in with 4 tires and said, "Oh, I want to return these 4 tires." And the shopkeeper looked at her and said, "Well, we don't stock tires." And she said, "No, I definitely bought them from here." Anyway, they gave her a refund anyway, because of the fact that they thought that one customer relationship was worth more than what 4 tires would cost in terms of the return. And that culture is driven from the top, and it permeates through the whole business. And there's another example probably that I can think of on the ASX. James Kelly at Lifestyle Communities. He has been a huge. I mean, the outsider would look at that business and say, "Okay, well, it's just a property developer. We've seen these listed on the ASX before, and they invariably do well for a period of time, and then run into difficulties with a poor development." He runs that business based on 2 key principles, and they are that the first one being you never get a second chance at a first impression, and the second one is that someone will forget what you told them, but they won't forget how you made them feel. And when I heard James say that for the first time, I thought, wow, I reckon this company could potentially have the key ingredients for what could be a successful business. I think it was trading at about $1.50 at the time, and I think it recently hit close to $20. Not doing anything particularly exciting, but just executing very well on a day-to-day basis. And I think there's a few examples like that. Keys Wheel at PWR, I think, is a fantastic example. The staff out there, they go in on a Friday, they all wear their favorite racing team colors. We went and visited the factory, and you very much get the feeling that those people working inside the business, they genuinely want to be there, and they're proud to work at a company like PWR. And people that are proud to work for the company and feel like they have ownership in the company tend to do, in my experience, a much better job for their business than someone who is just told from the top what to do and get on with it. And while we're on the topic of examples, you look at a company like Johns Lyng Group. It's run by a guy called Scott Didier, and the way that Johns Lyng, the business to start with, is in insurance, building, and restoration. And again, you look at that business from the outside and you think, okay, well, it's a building business. It's a commercial contractor that really should trade on a low multiple. But the way that they run their business is essentially they'll find 2 partners essentially to run one of their divisions, and they call them rock star partners, and they outline in their annual report what they look for in these partners. And they hire on integrity and character over what someone's CV looks like, with the view that they'll be able to train them and grow them into being a fantastic operator. They'll give those 2 operators 20% of the company, of that division, and Johns Lyng will own the other 80%. And that ownership and culture that's driven by doing so has propelled that business to become a daylight leader in their field. And that they're the kind of key ingredients that we're trying to find, and we're trying to find them based on the research that we've done of businesses offshore. And they can come in various forms. They can come from very low margin. I mean, if you look at Costco in the US, it's been a hugely successful business that's run on extremely low margins. When the analyst looked at that originally and said, well, it's a low margin business, it can't be high quality. But it turned out that the culture of the business and the way that they ran the company and treated their customers and suppliers ended up being a key ingredient to their success, despite from the outside it not looking like a particularly attractive business. And that they're the key ingredients that we are trying to look for, and they're not easy to find. But the more we look at good quality companies and how they've been successful there's a company listed, a bit closer to home. There's a company listed in New Zealand called Main Freight. It was started in 1978 in logistics, which is a hugely competitive industry. And investors in that company have made over 100 times on their money, and it's just a fantastically well-run business. They put their profit and loss for each week, sits on the wall so all staff can see. So everyone's understanding, what the business is doing. Everyone's on the same page. That high level of transparency. It's these little key ingredients that end up creating a business that I think can take market share and win. And that's not always obvious from the industry they're in, or simply looking at what the business does or what the numbers look like in any given year.
I like how you disclosed the insights that could come about from reviewing management incentive structures. I think there's a lot of focus on, as in lower level management, not executive management. I think there's a lot of focus on executive management when people talk about stocks and companies, but actually trying to understand how the lower level or lower tiers of management are incentivized, and the attitudes is probably the real engine that drives high returns on capital for businesses.
Yeah, look, I agree with that, and I think that a great and not every company operates this way, but a great way of managing teams like that we've seen is through a decentralized management structure. I mean, Berkshire Hathaway is probably the most successful company that's employed that type of structure. But another business we own called Supply Networks, they sell parts for trucks and buses. They've got, probably 25 branches around Australia. And if you're sitting at head office and you've got a branch up in North Queensland, the manager of that branch is going to know more about the customers in that area and what they require and what is going to drive them to buy products from Supply Network, rather than someone who's directing instructions from Sydney or Melbourne. And that approach, certainly that I've seen. I mean, the example I gave before of Johns Lyng, it's been successful for them. That approach can often mean that these management teams, or the branch level managers or lower level executives, can feel ownership in a company and purpose in a company. And people that have a sense of purpose will do a better job. And it's our experience that companies that operate in that way, particularly if you've got a lot of, Supply Network probably only has, as I said, around 25, but some companies have thousands of stores throughout Australia and even globally. How can they manage those stores effectively? Well, one way to do it might be to have the manager of those each individual stores making decisions with the company philosophy in mind, but making decisions that are going to suit that particular area and the customers in that particular area, and monitor that by looking at weekly sales records and staying on top of them. But I think the decision-making part of things, if they can leave them on their own, it can often lead to better outcomes.
Yeah, I think decentralized structure resonates really well with me. Like, having spent maybe nearly a decade in the commercial workforce in accounting, I think I do enjoy a more decentralized structure where it's more of a hands-off approach, where you actually feel like you have more responsibility. I'm not sure how you may have felt through your roles in previous funds and institutions, but I think you probably feel more empowered when you're given more responsibility.
Yeah, I think, look, everyone, it would surprise me if most people listening to this podcast hadn't worked somewhere whereby the top level management made a decision that you just thought, that is not going to help our customers. And unfortunately, that's the way that a lot of businesses are run.
Now, just to probably move away, we've talked a lot about cultures, management, and organizations. I think it'd be very interesting for listeners to hear about your valuation process. So more about numbers rather than the qualitative aspects of your process.
Yep. So valuation's a funny one, because I've seen very smart people in this industry try to model out a company, to the nth degree, and try to come up with a valuation that makes sense to them. And it has been my experience that the more complicated that is, the more likelihood of them being wrong. And so the way that we approach valuation is fairly simple. We prefer to use the cash flow statement than we do the profit and loss statement. And the reason for that is because the cash doesn't lie, whereas the profit and loss statement can. There are various ways to manipulate the profit and loss statement, but the cash that's coming into the business is often a very good indicator for what the true profitability of that company looks like. So we tend to focus on the cash flow and the balance sheet more than we do the P&L. And the way that we value a business is simply by looking at, what does that business earn most of the time in terms of a free cash flow yield? And then we'll compare it to various alternatives. I mean, investing is essentially, comparing your options to various alternatives, whether there are other companies listed on the stock market, whether it's other asset classes like property or bonds. If we can find in the current environment a good quality business that's growing organically at 10 to 15%, we're paying a 5% free cash flow yield for that business with a strong balance sheet, and it's driving unlevered returns, then that seems to us to be a fairly healthy valuation, rather than, if you pick up an analyst report, they'll look at EVs to EBITDA, they'll look at PE, 9 times out of 10, they'll create a valuation based on a 10-year discounted cash flow model. Now, if anyone had ever done a 10-year DCF and got it right, I would be amazingly surprised. I mean, no one can predict what's going to happen in 10 years' time. So we look at the companies, today, and we obviously make an assessment of what we think it might be able to earn down the track. And if we're paying a reasonable price for it, then we can still be wrong on what the company eventually ends up earning. But the valuation that we're paying today will hopefully mean that if the company does well, we'll end up doing well by owning shares in it.
You highlight the importance of return on invested capital as a key metric. So as for that key metric, do you often use free cash flow to try and monitor? Yeah,
we'll just use free cash flow over, I mean, it'll depend on what company is, but usually just free cash flow over the capital base, normally the equity or the issued capital. Sometimes a little bit subjective, depends on if the company's holding a huge amount of retained earnings, or if they're holding assets at cost rather than true value. It can move around a little bit, but you tend to get a pretty good idea pretty quickly.
So it seems like you're trying to understand the key cogs in the overall business that are going to extract value in terms of free cash flow.
Yeah, that's right. And sometimes a backward looking approach can help as well, and we can say, okay, well, this business that we're looking at, over the last 5 years, the return on capital has been pretty poor. If we're going to own it today and what we think is a reasonable valuation, why do we think the return on capital of that company is going to improve? If it's a company that's demonstrated they can provide high returns on capital, then that obviously gives us increased confidence that they'll be able to do it in the future.
Excellent. So we talked about your background, your investing philosophy, management culture, a lot of practical examples. Were there any books and resources or famous investors that really shaped your overall process?
Yeah, so with regards to books, I would read a new book every 2 weeks at least. And I think that I've learned an incredibly more from reading books about companies, about investing, like successful investors, than I ever did from any of my previous academic work. There was a guy I worked for at Moelis, which was now called MA Financial, who runs some funds for them, called John Garrett, and he really drove that approach for me, and recommended a huge amount of books which I had never heard of, that just had been fantastic in understanding, helping me understand what makes a good business versus what doesn't. He actually has a website called mastersinvest.com, And essentially on that website, he has collated what he thinks are the most important lessons from great investors and great business leaders, and compiled them into various quotes sorted by subject matter. So I think that's a fantastic resource. And then in terms of books, the best one that I read this year was Investing for Growth by Terry Smith. So Terry is a fund manager out of the UK, employs a very much a return on capital approach to investing. And the book is essentially a collection of his investment writings over the last period of time running the fund, which is called Fundsmith. And, I took a huge amount of insight from that. William Thorndike's book, The Outsiders, profiles 8 CEOs who ran businesses not necessarily in the most high returning businesses, sometimes in very competitive industries, but ended up doing a fantastic job for shareholders. I think that is just an exceptional book, one that I've read more than once now, with some great lessons in it. And the more that you understand how those, call it outsiders, operate, the more that you can sort of pick up these in terms of whether they possess any of the quality of those managed in that book. I mentioned Built from Scratch, the book about Home Depot. That's a story that I'm just fascinated with in terms of how it was so successful. Ken Langone has a book called I Love Capitalism. He was very much involved in that Home Depot story as well. And then probably the other one off the top of my head is the Mainfreight book. So I mentioned Mainfreight before. Investors have made over 100 times their money. They've got a book called Ready, Fire, Aim, and essentially profiles the story of that business since they started. And there's a huge amount of lessons in there, I think, not only for investors but for other people running businesses that they can learn, which I took a huge amount of insight from. But I think that, certainly for me, reading regularly has just been the absolute difference in forming my investing approach, and it helping me understand, why a good business is that way, why a business can be more successful than competitors. If you look at 2 businesses from the outside in the same industry, which one's going to win, which one's going to take market share? And, it's been my experience that, you start to pick up these patterns for recognizing, where and when that might be able to happen.
Yeah, I love this approach in terms of building a pattern recognition to identify future high quality businesses. Do you often take notes when you read these books?
Yeah, I'll often highlight and underline, and usually write up some form of notes that I can go back to. Okay. And then even just rereading the good books that I've read in the past.
Okay, awesome. So we've talked about how important people are in an organization, and I think the closest people within one circle plays a very important role in shaping or developing someone. So I'd like to ask you, who's had the most influence on you personally and professionally as an investor, and why?
Yeah, it's head and shoulders without a doubt. John Garrett, who I mentioned before, he has just had a huge. I started working with John probably 8 or 9 years ago, and his influence on me as an investor and the lessons that he's taught me have just been incredible. I haven't come across any other investor that even comes close to the insights he has. It's just extraordinary. He loves the stock market. He's got an incredible passion for it. That passion is infectious. It rubs off on anyone that's around him, and I think he's going to go on to be an incredibly successful investor.
Yeah, I've seen a lot of his posts on Twitter, and also a lot of his summaries of the great books like Charlie Munger and Chuck Ackery and Warren Buffett. And it's incredible how many books he absolutely devours.
Oh, it's extraordinary. I mean, you can't keep up with someone like that. Just his passion and desire to continue to be learning and find new approaches and even debunk his current ideas is just incredible. I mean, you can't compete with that. So yeah, follow him on Twitter on Masters Invest is a great way to stay in touch with the things that he's thinking about.
What's the best way to get in touch with yourself?
So our website's hayboroughinvest.com.au. Anyone can email me, have a chat, or George. George is probably better for insights than I am. And we're always happy to have a chat, meet new people, talk about stocks. We love it. It's what we do day in, day out. It doesn't feel like a job for us. It's something that we would do, even if there was no money involved behind it. We just love it. So always happy to have a chat to investors and talk about stocks.
Well, it's been extremely fortunate to have you on the Australian Investors Podcast. I think the Australian investing community would gain a lot of lessons and insights from your practical examples on the importance of culture, management, and also the way you carry about your investing. And also good luck in the new year with your fund.
Yeah, thank you, Raymond, and thank you for having me on the show. I really appreciate it.
Thank you,
Have a
Ben.
great Christmas.
You too.